please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, let's cut across to Mr. Raamdeo Agrawal, co-founder of Motilal Oswal Financial Services. They're addressing the press on the Q1 results.
The equivalent profit, if there is no change, it is 115 crores. So that gives about 13% growth. But if you go by Index, then it is minus 2%. 100 crores against 107 crores. If we restate the last year's number, it will go to about 107, and now it is about 101. So we have all sorts of, and then there is another unadjusted PAT, which turns over 115 crores against 146 crores. So I think I think Index versus Index, I think we'll do it next year. Because there is no base for the last year. Last year it was 101 crores profit, and as per the same system, if we declare now, it is about 115. So that's about 10-12% growth. The highlights of this quarter is, so let me just go to all the operating businesses which we have in capital markets and asset management. So in capital markets, the broking grew by about 22% in top line. Investment banking is very lumpy, so this quarter was somewhat muted in terms of completion of deals. There are only 2 deals which got completed. So we had only 15 crores revenue against 23 crores last year. Asset management saw robust growth about 40%, and wealth management grew more like 47%. Private equity grew 90%. Housing finance is one operating business which remained very muted at about 1%. So except for housing finance, all the capital market businesses, they grew anywhere between 40 to 60%, and with a very stable to improving margins.
Okay, that's Mr. Raamdeo Agrawal talking about Motilal Oswal's numbers for the quarter, 2% down on that stock. Not much is moving in the market, but Tech Mahindra is taking off quite a bit. We were in conversation with the management in the morning itself, sounded quite optimistic about the deal pickup. That's a stock now that is at the day's high. Well, speaking of stocks that are moving around, let's get in both Ashwini and Rajat to look at some midday strategies. Ashwini, very quiet on the indices. Bank Nifty is still struggling. What's the call and which way would you go now?
See, I don't think there's great action on the indices. Morning we got the trade on Bank Nifty, but no, markets don't go up and suddenly one day turn down and keep going down. We are in a sideways phase. Now, out of that sideways phase, we'll have to see which way the markets crumble. But I don't think incrementally there's something to do on Bank Nifty. Individual stocks, Oro Pharma is a buy with a stop of 680, target of 705. Larsen is a buy with a stop of 1330, target of 1375. And BPCL is a sell with a stop of 362, target of 345.
Okay, all right, Ashwini, thanks so much for that. Well, some of these metal stocks, Hindalco is coming for some profit booking, so that's moving lower as we speak. And Tata Motors, who would have thought? The promoters go in there, they buy 2.6 crore shares. They've done this even in the last year as well. But they bought 2.6 crore shares. The numbers weren't great. Their stock has fallen nearly around 4% from there. So a couple of sessions ago, it was at around 270 rupees odd. That stock, in fact, is coming for selling pressure. I think the fundamentals and the operational performance will have to improve, and then we could see some bit of a relief as well. But let's go across to Rajat. Rajat, what's your trade on the index, as well as what are the calls you have for us today?
So as the index is concerned, Bank Nifty is decisively weak and it needs to cross 28,106 in order to really show some recovery. Unless that critical level is taken out decisively, you do not...
Okay, Rajat, I think we'll have to just go back and fix that audio. The line isn't very clear. Ashwini, I just wanted to come back to you on, any mid-cap ideas that you might be working with. For instance, even today, second day running, Kajaria is finding interesting buying. This has been, a stock on a downhill for so long. It's up 5% today. Then the FMCG names, they continue to move higher, Dabur, Nestle, etc. Anything beyond the Nifty 50, any mid-cap themes?
See, I like to go wherever there's a macro trend. And the macro trend clearly is in pharma. So all kinds of mid-cap, large-cap pharmas, they're doing well. That's where you need to focus on. This Kajaria, they tend to move up 2 or 3 days and then they kind of consolidate again. But this is a pullback move on Kajaria. My sense is that. And individually, things like Wockhardt, Cadila, Aurobindo Pharma, Glenmark, which has been in a bearish context for a long time. Those are the kind of stocks you need to back up, because the pharma index is clearly bottoming out and possibly moving up for a large rally.
Okay, all right. Pharma index is bracing itself for a large rally. Thanks so much, Ashwini, as well as Rajat, for joining in and giving us all those picks. But let's see how the European markets are doing. Remember, yesterday, most of them, the frontliners, they ended with some mild green. You had the auto sector that was underperforming, but yet we had those indices opening up in the green. And today, it's as flat as can be. So we'll wait for a bit, and then, in fact, we'll see how those rates stabilize out there. I think my director will pull up some of Rajat's picks as well, so you don't miss out on that. For the time being, we'll slip into a short break. You come back, and we'll focus on the markets as well as on stock-specific action.
Welcome back. Well, today it's the curtain raiser to Motilal Oswal's 14th annual Global Investor Conference. Our colleagues Lata Venkatesh and Nimesh Shah are with the entire top team at Motilal Oswal to get a sense of what's lined up this year. So let's go across to them.
We have with us the brains trust of Motilal Oswal. And why? Because this is the curtain raiser to the 14th annual Global Investor Conference of Motilal Oswal, often a much-watched event. And I have with me, as I said, the brains trust, Gautam Dugad, Naveen Agarwal and Rajat Rajguria. Gentlemen, thank you very much. Thanks especially from me and Nimesh for giving us some insight into what you are expecting from the conference. But before we get to the conference, day after day, we at CNBC TV18 are very happy to announce that the Nifty is at new highs. Just a few days back, 11,500 scaled, now 11,600 scaled. So let me start over there, Rajat. If we are at this level, I saw your earnings forecast. Your Nifty earnings forecast is a 21% rise perhaps in the current, or a 20% rise in the current year to 547. And next year you are expecting a further 26% rise to about 688. But is not all that in the price? Even now the FY19 EPS, Nifty EPS, Nifty would be trading at some 21 times. Are we not richly valued?
So I think there are two ways to look at this. First, if you look at our earnings, we have been actually growing at a rate of about 15 to 16% for the last many quarters. But these numbers get distorted because of a couple of corporate lenders and adjustments from a couple of PSUs, because of which the reported growth sometimes looks as low as 5 to 7, yes, and the forward numbers looks as high as 20 to 25. But more importantly, the underlying growth rate has reverted back to about 15 to 16%. That's a welcome sign, right? Secondly, I think the markets are right now partly reflecting the optimism that it sees from the recovery in this earnings cycle. You may look at markets at its all-time high, but aren't they what they are supposed to do? Because as a country, if every year your GDP keeps growing, makes a new high, if your earnings growth keeps growing at whatever rate, but makes a new high, so the markets will just follow some of these matrices with its own share of volatility, right? So I think when you look at forward multiples, the markets may look at above the long-term average multiples, yes, but the earnings growth cycle is what it is more excited about right now. Okay. And as we have seen the disappointments in the last 7-8 years of down cycle, we may be up for surprises in this upcycle also. Okay,
I just want to persist with you, Gautam, on this point. See, it's your report I'm reading, and you are saying that Nifty is trading at a forward P of 18.8 times, and this is at a 21% premium to its long period average. The Nifty price to book is at 2.8 times, and that is 8% premium to long-term average. While it has every right to be at new highs, does it have a right to be at this high highs?
So there are two ways to look at it. When you look at averages, there are always some distortions. Look at Nifty's composition, how it has changed in the last 7-8 years. You used to have telecom, capital goods, oil and gas at 8 to 10% weightages in Nifty those days.
Yes.
today you have 80% of the index comprised of private banks, financials, consumption, auto, and IT, right? Now, these are sectors which always trade at a higher P than the cyclicals because they have a higher ROE and slightly more structural trajectory to their growth. So while from an academic viewpoint, you can always compare the averages of today's P versus 10-year averages. Given the way the Nifty composition has changed in the last 10 years, those averages are not as relevant today as they may be 5-6 years back. That is point number one. Point number two is, when you are at an inflection of earnings, see today I am far more confident on earnings recovery at any given point of time in the last 3 years than I was. If you look at the commentaries of corporate lenders, which have been the biggest disappointment, by the way, if you look at Nifty earnings growth itself for last 3 years, excluding these 3 banks, so you are still looking at 47 Nifty companies put together. The earnings growth was 10% in FY16, 17% in FY17, 10% again in FY18, and we're projecting it to be 17 and 18%. So the numbers 21, 26, while they look disproportionately high, they are bumped up because of the extremely low base of these 3 banks, and of course Tata Motors also. So market will obviously precede the earnings up move, and that is what we are seeing. You've seen the rally extend after the last quarterly result season got over, despite so many worries on the global front, Turkey, currency, crude oil, global trade war concerns. So market is climbing a wall of worry because it is forcing an earnings recovery in a lot of sectors.
Okay. Well, from macros to micros then.
Okay. If I can add to Gautam's point, you are looking at a P multiple of 18.8 times, which is a 21% premium, right? But if you look at what is P? P is market price divided by profits, right?
Yes.
The profits in FY18 for the Indian corporate sector is at 3.6% of the GDP. Over the last 15 years, this number has been over 5%. And at the peak, this was at 7.8%. So the profit base, because of the way corporate lenders have behaved, because of the way pharma sector has behaved, capital goods sector has behaved, and sector after sector has behaved, is at a 15-year low.
Okay.
At a 15-year low, if you look at the market cap to GDP now, we are trading at about 80%. The market cap of all companies in India is 157 trillion, which is 80% of the GDP of India, which is where it has been for the last 15 years. And the peak of market cap to GDP for India is 150%. So we are half of that peak. Just gives you a context of, whether we are richly valued in the context of normalized earnings. You're looking at reported earnings just for 1 year. If you were to normalize the margins or the corporate profit to GDP, then the valuations may look less richer than the 21% premium that you alluded to.
Fair point. That's extremely well argued, but now we want to go from averages to specifics.
Correct. So, before I get into specifics into individual sectors as well as what you are going to present at the conference as well. But first, one word on while we spoke about earnings picking up and he's expecting a 20-25% earnings growth, Uday Kotak very nicely put out this year that this is a year when the micros are good, but the macros are going to be challenging. You have crude at 75, rupee at 70, trade war risk. How are you looking at the risk, factors from the market point of view?
I mean, there are clearly these risks manifesting in substantial slowdown in FII flows in the last fiscal year. In fact, in the first 4 months of this year, FII flows have been negative. However, if you look at the DII flows, in the first 4 months of this year, it has already been $6 billion, which is a run rate of $18 billion, which is similar to the flows that we saw last year, which was also $18 billion.
That is the reason why markets are supportive, right?
Absolutely. So what I'm trying to say is that there are foreigners who are withdrawing from Indian debt, there are foreigners who are withdrawing from Indian equities, because to them, Indian macro is concerning compared to macros elsewhere. Right. However, as far as the domestic saver is concerned, he does not have the same flexibility to move between India and the other emerging markets or between emerging markets and developed markets. And I think as far as the micro is concerned, as Mr. Kotak rightly articulated, that's the one which is looking interesting. Corporate earnings are the ones which are looking interesting. And that's the reason why we see flows continuing in equities, and hence, markets unlikely to see any major correction due to the point on macros that you articulated.
Okay. I take your point. For the foreign investor, there are other options. For the Indian investor, probably between asset classes, equity is still a superb option, considering where real estate and gold are. But now I really want to get to the specifics, especially because it's a favorite sector. ICICI Bank is your preferred pick while playing recovery. But why only ICICI? Okay, you also have BOB. But I mean, a corporate lender would also be Axis. Corporate lender is also BOB. And we are seeing signs of strengthening in other sectors, in other corporate lenders as well. So would you increase your basket as you see these banks perform? Or are you sticking to these two?
So 2 points you've missed. If you see my model portfolio, there is SBI also and there is S-Bank also. Okay. So there is SBI, ICICI, S-Bank, which are part of my model portfolio. What you are looking at is perhaps the quarterly top idea share.
Yes, yes.
So as you rightly mentioned, we are seeing a big turn, at least as far as commentary is concerned, on the corporate lenders. I think give a quarter or two here or there, you are seeing a upturn in the corporate asset quality. Obviously, as you've seen the commentaries of most of the banks and numbers, slippages, all of those things put together, if you see the key operational indicators, it seems that worst is behind as far as that part of the bucket is concerned. Secondly, if you see the stock price movement itself over the last 45-50 days, ever since the results started pouring in from corporate banks, you have seen that some shift has happened already in the portfolios from richly valued private retail banks incrementally towards private corporate banks. You have not seen a big bang shift towards the PSU corporate lenders, which are on the mid-cap side. Okay. So yes, it is possible, but from a longer-term perspective, from a 3-year, 5-year, 10-year point of view, I still think that the value migration potential, which a lot of these private financials offer, that is too huge to be ignored for a 6 months, 12 months tactical shift in the portfolios, which is happening in favor of corporate banks.
Okay. Well, let me come to NBFCs. I do see even in your top 10 you have L&T Finance, but it looks like they're out to grab market share, especially from public sector banks, but not necessarily only. It seems to be generally from the banking sector. Do you see that in the days to come, you will find more of them populating your top 10 or top 30?
See, it has already happened. If you look at the profit pool of my universe, NBFC's profit pool today is 33,000 crores, sorry, 28,000 crores, which is almost approaching the consumer profit pool of my universe, which is at 33,000 crores. 5-6 years back, this was unthinkable, right? So as you see the proportion of profit pool rising in favor of NBFCs, secondly, what has also happened is the space has opened up because of the stress in public sector banks. So the opportunity is huge. The size of prize is very big. And a lot of these NBFCs, which have done well over the last 3 years, 4 years, they have a lot of room to still grow.
Okay. Welcome back, and let's chat commodities now, where we have seen the metal prices come under pressure. This is because the US dollar index has rebounded yet again. This is on the back of the remarks from the US president, expectation that you would also see an interest rate hike in the month of September. The CME futures show a 96% probability of that. And of course, it also has to do with the initial sentiment that the US-China talk, which concludes today, wouldn't yield much of a result. You will just get perhaps a joint press meeting or conference from both of them and a further date on, but nothing really would be of consequence from there, and that's what weighing onto that metal space. So everything in the industrial metals, precious metals, has come under pressure today. Ranisha Chanani now joins us to give her strategies on that space. Ranisha, hi. Starting with the base metal prices first, and we have seen almost everything from copper to nickel to zinc decline today. How are you reading the price moves, and what is your strategy?
Hi Manisha, yes, we have seen entire commodity space under pressure because of dollar index strengthening, and as you rightly said, these are the two main factors, like Fed meeting minutes, which wanted that there would be 2 more rate hikes in this year, and also we will not see anything much concrete from the US-China trade talks, which is going on today. And from today, we have that $16 billion of goods where 25% tariffs is going to be applied. So this is creating a negative sentiment in the market and risk-off sentiment in the market, and entire commodity space is sold off. So if you talk about copper, nickel, those fundamentals are not too bad. If you look at demand-supply fundamentals, they are not too bad. But because of this negative sentiment, we are seeing the sell-off. And I think today, again, this sell-off would continue. So I would recommend nickel to be sold around 935 for the targets of 920 and 915 on lower side.
And Anisha, do you continue with your sell calls on the precious metal space? Because we did see the gold prices rebound from those 19-month lows. But then again, 1200 continues to be a resistance.
Yes, Manisha, 1200 for gold and roughly $15 for silver. These both, which were the support levels earlier, are acting as resistance now, and prices are not able to cross these levels. Still, we are seeing that dollar index is continuously trading above 95 level. I don't think gold and silver would take a jump from here. They'll continue to underperform from here. So I'm waiting. If dollar index falls below 95, then only there could be some buying that could be in precious metal pack. And as I said, like there is risk of sentiment in the market. We are seeing the safer and buying only in dollar, not in gold and silver. So precious metal would continue to trade in pressure. So for today, silver could be sold around 36,700 for the targets of 36,200.
Okay, Renisha, thank you so much for joining us. Well, that really is the cue coming in. It's a sell call in the metal space that continues for the day today as well.
All right, Manisha, thank you very much for that. And with that, we're completely out of time. We have to take a quick break. We will come back and get you a little more on the markets. Welcome back. Absolutely flat as far as the indices are concerned, but there's some movement building up on individual stocks. Let's pull up Maruti, for instance. Maruti is now quickly racing towards the highs of the day, over 1%, almost 1.5% on that stock. Let's get the intraday going. It's at the day's high, that one counter. And from the mid-cap universe, we should probably look at today's listing. It's been a pretty smart recovery for Credit Access, actually. Credit Access was down 7% first tick when the listing actually took place. And now that's a stock that has rebounded. It's actually positive, 2 rupees higher on Credit Access. Some other interesting names continue to be from the pharma space. Glenmark Pharma sitting on 2.5% rally, 52-week highs for that stock. And Bata continues its journey in blue sky territory. Again, a day of 52-week high, a fresh high for that stock. Pretty much at the day's top position at the moment. That's Bata for you. Well, with that, we're going to take your leave on this edition of Halftime Report. Do stay with us. Business Lunch will take all the action forward.